Hey, welcome to our YouTube channel. Here, we'll take you through the journey of how the equity mutual funds V works. Whether you're new to investing or just curious about the mutual funds, you're in the right place. The story of equity, mutual funds, a path to wealth. Chapter 1, the beginnings of collective wealth. Picture this, a group of people, each with a small sum of money, coming together with a shared goal to grow their wealth. Alone, they might not have enough capital or knowledge to take on the stock market, but together, they can create something more powerful. This is where equity mutual funds begin their story. An equity mutual fund is essentially a pool of money gathered from many investors. The fund manager, who's like a skilled captain of a ship, steers this collective investment toward the stock market, buying shares in publicly listed companies. These companies can be large, well-established businesses, or smaller, high-growth ones, depending on the fund's strategy. The goal? To create long-term capital appreciation, or in simpler terms, to help each investor's money grow over time. Chapter 2. How the fund works its magic. When you invest in an equity mutual fund, you're buying units of the fund. Think of these units as pieces of the pie. The more money you put in, the bigger your share. The value of these units changes daily, based on how the stocks in the fund are performing. This value is called the net asset value, NAV. Now, what does the fund manager do with all the pooled money? They invest it in stocks, lots of them. A key principle is diversification, meaning spreading the investments across different sectors and companies to reduce risk. Imagine owning shares in 30 to 50 companies, each from a different industry: banking, pharmaceuticals, IT, consumer goods, and more. This mix helps balance out the ups and downs of any one stock. Analysis, aiming to beat the market and deliver strong returns. Chapter 3, the daily dance of NAV. At the heart of every equity mutual fund is the net asset value, NAV, a number that tells you how much each unit of the fund is worth. The NAV fluctuates daily, like the tide, based on how the stocks in the fund perform. When stocks rise, the NAV goes up, and when they fall, so does the NAV. Chapter 4, the risk and reward of equity mutual funds. Of course, with potential reward comes risk. Equity mutual funds are not a guaranteed win. The stock market is volatile, meaning your fund's value can swing wildly. Capital appreciation happens when the value of the stocks in the fund rises, meaning your investment grows. Some companies also pay dividends, which are a portion of their profits. These dividends can either be paid to you directly or reinvested into the fund to help your money grow faster. But keep in mind that stock markets can be unpredictable. If the market dips, the value of your investment might go down, at least in the short term. Chapter 5. Types of equity. Mutual funds. Choose your adventure. There are many paths you can take when it comes to equity mutual funds. Here are some options: large cap funds, mid cap and small cap funds, sectoral/thematic funds, index funds, ELSS funds, equity linked savings scheme. These tax-saving funds come with a 3-year lock-in period, but allow you to save on taxes under Section 80C of the Income Tax Act. Chapter 6, the exit strategy, redeeming your units. When you decide it's time to cash out, you can redeem, sell your units at the current NAV. The beauty of equity mutual funds is that you can sell your units at any time. Your redemption amount will be based on the NAV on the day you make your request. Chapter 7, costs and fees, what you pay for. Like any service, there are fees associated with mutual funds. Expense ratio. This is the fee that the fund charges to manage your investment. It's a percentage of the fund's total assets and covers everything from administrative costs to fund manager fees. Exit load. Some funds charge a fee if you redeem your units within a certain period. This is designed to discourage short-term trading. Chapter 8, the pros and cons. Is it right for you? Advantages. Professional management. You don't have to pick stocks or manage your portfolio. Skilled fund managers do it for you. Diversification. By investing in a wide range of stocks, your risk is spread out, reducing the impact of a poor-performing stock. Liquidity. You can buy or sell units at any time, except in the case of ELSS. Compounding growth. Over the long term, your investment can grow exponentially thanks to compounding. Disadvantages. Market risk. Your returns are tied to the performance of the stock market, and there's no guarantee that the market will always be up. Management fees. Actively managed funds can have higher fees, which could eat into your returns. No guaranteed returns. Unlike fixed income investments, equity mutual funds don't promise a fixed return. Conclusion. The journey ahead. Equity mutual funds are an exciting journey for investors willing to embrace risk for the potential of higher returns. They offer a way to participate in the stock market without the need for stock picking expertise and with a diversified approach to reduce risk. If you're in it for the long haul and ready to weather market fluctuations, equity mutual funds could be a powerful tool in your investment arsenal. Just be sure to understand the risks involved and choose a fund that aligns with your financial goals and risk tolerance.